Assalamualaikum to Dr. Hairul Nizam and my fellow friends. Today, my group would like to present about ASEAN Financial Crisis 1997 and Subprime Mortgage 2008. Before we proceed, I would like to introduce our group member. I'm Ada Zakira binti Fauzi, Ainul Fatin Arisha binti Syaiful Zaman, Nadira binti Abdul Razak, Nur Syafiqah Amira binti Mat Syarudin, Nur Sharmin binti Muhammad Nurizam, Nur Hidayah binti Ismail, and Nur Suhaiza binti Saudi.
Assalamualaikum everyone, my name is Nur Sharmin. In my part of presentation, I will make an introduction about Asian financial crisis. Before Asian financial crisis occurred, Asian countries such as South Korea, Taiwan, Singapore was referred as Asian tiger economies and had a rapid growth over 7% in 1960 until 1990s. However, at the end of July 1997, Asian region was hit by the worst economic crisis in decades. A collapse of Thai baht caused a domino effect in the region, causing their currency to come under attack, followed by rapid depreciation. In mid-May 1997, Thai baht was hit by massive speculative attacks, and since the currency was pegged with the central bank had to deplete it to reserve the baht currency. Although the government was reluctant to leave the USD baht peg, it lacked the foreign reserve required to support it and had no choice but to float the currency. On 2nd July 1997, Thai government had no choice but to allow the exchange rate to be set by the market, but faced a depreciation about 20% and caused a chain reaction of events that led to region-wide crisis. To know further about the cause, the impact and lesson about Asian financial crisis, I will pass to the next presenter. Thank you.
Thank you, Sharmin. Hi and Assalamualaikum. My name is Ainul Fatin Arisha binti Syaiful Zaman. I'm going to present on the factors of Asian financial crisis 1997. The long-term causes of the Asian financial crisis is because the foreign debt to GDP ratio rose from 100% to 167%. In the four large Asian economies in 1993 until 1996, foreign companies were attracting capital inflows from the developed world. Investors in the West were seeking better rates of return, and the Asian economic miracle seemed to offer better rates of return than lower growth economies in the West. According to Zubair Hadan, the Malaysian economy had largely been a good condition since independence. In recent years, it had enjoyed full employment, considerable stability in the price level and high growth, with the average rate being 8.7% during the period of 1990 until 1997. Also, the long-term causes is because the current account deficit. Countries like Thailand, Indonesia, South Korea had large current account deficits. This means they were importing more goods and services than they were exporting. It reflected very high rates of economic growth and consumption. The current account deficits were financed by hot money flows, which is on capital account. Hot money flows were accumulated because of higher interest rate in the East. Also, the next one is the fixed or semi-fixed exchange rates. These made currencies vulnerable to speculation. Also, interest rates were used to maintain the value of the currency, causing relatively high interest rates in Southeast Asia, which caused hot money flows. The next one is financial deregulation. Financial deregulation encouraged loans and helped to create asset bubbles. But the regulatory framework and structure of banking firms meant loans were often made without sufficient scrutiny of profitability and rates of return. This had caused the underdevelopment of non-banking institutions, capital markets and risk management products, risk intermediaries, trading and market making, which had functioned under inconsistent macroeconomic policies. Other than that, the long-term causes is because the moral hazard. Moral hazard with a strong political desire for rapid economic growth, governments often give implicit guarantees to private sector projects. This was magnified by the close relationships between large firms, banks and the government. This closeness encouraged private firms to place less emphasis of the cost of project and assumption expansion plans would be supported by the government. And lastly, because of over-exuberance. The booming economy and the booming property markets encourage expensive borrowing by firms. It also encouraged international investors to move the capital to these fast-growing economies. There was an element of irrational exuberance, which is the idea that Asian economies were undergoing the economic miracle where high returns were granted. So in the previous slide, I already explained about the long-term causes. Now I will continue to the unexpected causes of the crisis. The first one is the higher US interest rates. In the late 1990s, the US started to increase interest rates to reduce US inflationary pressures. Higher interest rates in the US made the East less attractive as a place to move hot money flows. As hot money flows into the East slowed down, Asian currencies started to fall and governments struggled to keep exchange rates at their fixed level against the US dollar. The next one is the Asian financial crisis is also known as Asian contagion. It was a sequence of currency devaluation and other events that began in the summer 1997 and spread throughout many Asian markets. So the contagion started on 2nd of July 1997. It is due to the speculative attacks that Thailand was forced to float their currency of Thai baht. This caused a rapid devaluation which triggered a loss of confidence throughout the Asian economies. Soon, other countries were forced to devalue as investors wanted to get out of Asian currencies. The next one is a debt default. In the run to the crisis, both government and private firms built up high in external debt ratios. However, the devaluations caused debt repayments to become more expensive, and as a result, firms and countries started to default on their debt repayments. When the Asian economic crisis occurred, the majority of the lenders took back their loans, and this caused the capital to outflow without any control. At this stage, the IMF intervened to try and stabilize the crisis. However, their intervention has proved very controversial, with many arguing that their intervention made things worse. Higher interest rates in Indonesia and the Philippines did not stop the devaluation of the currency. It's suggesting that investors were not convinced with the high interest rates were sustainable. The IMF insisted on fiscal restraint, which are lower spending, higher taxations, and also the privatization. This contractionary fiscal policy caused the economic downturn and the economy plunged into recession. Bankruptcy increased and there was a flight of capital. That's all from me. I will pass to the next presenter, Suhaiza.
Thank you, Ainul. Assalamualaikum. My name is Nur Suhaiza. Today, I am going to present the impact of Asian financial crisis 1997. Asian financial crisis 1997 refers to a macroeconomic shocks experienced by several Asian economies, including Thailand, Philippines, Malaysia, South Korea, and Indonesia. The crisis followed by several years of rapid economic growth, capital inflows, and build-up of debt, which leads to unbalanced economy. Due to this crisis, it gave a huge impact to the Asian economy. The first impact due to the Asian financial crisis 1997 is reducing growth and real wealth. The implications of the regional financial crisis for Asians are far-reaching. For individual members, the pains of significantly reduced growth and hence output have been compounded by substantial losses in real wealth. Many Asian governments are now faced with a range of social and political problems arising from climbing unemployment, reduced real incomes and purchasing powers. They must also address the administrative and regulatory capacity of governments in an economic environment characterized by uncertainty and instability. Secondly, the regional crisis also has potential implications for Asian cohesiveness in the medium to the longer term. For example, a sustained regionalization could further worsen ethnic tensions already visible in Indonesia, social problems associated with large flows of migrant labor and possibly political refugees, and the effects of a range of environmental problems related to the drought and unsustainable development. In Malaysia, the total of unemployment rate is increases. Malaysia also suffered from a shortage of labor. During financial crisis occur, total number of workers retrenched was 83,865 people. It almost 81.1%. According to the Ministry of Human Resources, shows that more employers adopt the new strategy to face the financial crisis, such as pay cuts of salary, temporary layoff, and voluntary layoff before sorting the permanent layoff. Next, during Asian financial crisis 1997, the declining in the import of luxury goods and domestic demand slowed due to the depreciation of currency. Malaysia currency, which is ringgit against the dollar value, depreciated almost 50%, hitting a high of RM4 ringgit and 88 of the US dollar. According to the Asian currency statistic, the baht also decreased by 29.1%, rupiah by 25.7%, and the peso declined by 23.1%. This leads to the declining the import of luxury goods. For Malaysia, especially in the resources base, has increased and display continued uptrend in ringgit term. However, when convert to US dollar, most major export categories display a downward trend. The proposal made by Malaysia Prime Minister Mahathir Mohamad to establish an Asian currency payment system for trade in local goods has been argued that such a system would reduce the demand for US dollars and help regional currencies retain their value, either through dominating intra-Asian trade in the export sources currency or establishing one currency. It makes the declining the import of luxury goods more serious. That's all from me. I will pass to the next presenter, Aida.
Thank you, Saiza. My name is Aida Zakira. I would like to talk about a lesson that we can learn from ASEAN financial crisis 1997. In 1997, this ASEAN financial crisis are like a thesis to the whole world. The speculators target Indonesia and South Korea. Both countries asked International Monetary Fund to help them. However, International Monetary Fund recommended very stringent interventions such as rising interest rate and reducing expenditure. Malaysia was still under strict, while its international borrowings were well controlled, but with moral hammered down and near panic in the markets. There were indications that locals were pulling their money out of ringgit on an unparalleled scale. Even the big Singapore and the open market, Hong Kong, have not been spared. While Malaysia never demanded or received assistance from the International Monetary Fund, the initial response under the Finance Minister and Deputy Prime Minister Anwar Ibrahim was to take International Monetary Fund like step by reducing spending and increasing interest rate. Meanwhile, the leadership disputes between Anwar and the Prime Minister turned Dr. Mahathir Mohamad intensified, contributing to the more confusion. Second lesson in ASEAN financial crisis is the early warning systems did not sound alarms. Investors and policy makers missed some warning signs of unsustainable lending booms, such as a high corporate debt to equity ratio. In 1996, those ratios more respectively 310% in Indonesia and 518% in Korea. High ratio of short-term debt to central bank reserve, an important measure of a country overall external foreign currency liquidity, were another red flag. In 1996, this ratio was 177% in Indonesia and 193% in Korea. However, some symptoms common in previous crises, such as excessive current account and budget deficit, were missing. Importantly, prior to the ASEAN financial crisis, early warning system focused on government external finance and ignore private debt stock that could become public liabilities because of implicit guarantees. That's all from me. I would like to pass to the next presenter. Thank you.
Now, I will make an introduction about subprime mortgage crisis. First of all, what is subprime mortgage? Subprime mortgage are named for the borrowers that the mortgage are given to. If the prime rate for a mortgage is what is offered to people with good credit and history of dependability, subprime is for people who have struggled to meet those standards. People who are approved with subprime mortgage historically have low credit scores and problem with debt. People with spotty credit like this often have tremendous difficulties getting approval on a mortgage, and as such the monthly payment have much higher interest rate than normal since the lender viewed the loan as more riskier. The United States subprime mortgage crisis was a nationwide financial crisis occurred between 2007 and 2010 that contributed to US recession of December 2007 until June 2009. It was triggered by large decline in home prices after the collapse of a housing bubble that leading to mortgage delinquency, foreclosure, and the devaluation of housing-related securities. Decline in residential investment preceded the recession and were followed by reduction in household spending and then business investment. Spending reduction were more significant in areas with a combination of high household debt and larger housing price decline. To know further about the cause, the impact and lesson, I will pass to the next presenter to make a presentation about it. Thank you.
Thank you, Sharmi. Assalamualaikum and hi, my name is Norinda Ismail. Today, I would like to present and discuss about the factors subprime mortgage crisis in 2018. Hedge funds, banks, and insurance companies are the ones that caused the subprime mortgage crisis. Alright, actually, hedge fund and bank, they created the mortgage-backed securities while insurance company covered with credit default swaps. Demand of mortgage lead to a sad bubble in housing. When Federal Reserve increased the federal fund rates, it sent adjustable mortgage interest rate skyrocketing. Therefore, the housing price plummeted and the borrowers defaulted. Now, I will further explain about the factors of the subprime mortgage crisis in year 2008. The first factors that affect is actually hedge fund. Played a key factors or key role in this crisis. Hedge fund always under pressure to outperform market. They created demand mortgage securities with guarantees called credit default swaps. And Federal started rising interest, and those with adjustable rate could not make higher payments. Securities that insurance company covered customer with credit default is now become worthless. American International Group AIG almost become bankrupt trying to cover the insurance. Second factors is derivative drove the subprime crisis. Bank and hedge fund itself actually made so much money selling mortgage-backed securities that allows lenders to bundle loans and resell them. It also allowed the bank to have more funds or money to lend out. With advent interest-only loan, it transfers risk of lenders defaulting when interest rate resets. Advent of interest-only loans combined with mortgage-backed securities adds so much liquidity in the market, so it created housing boom. Factor is subprime and interest-only mortgage don't mix. Subprime borrowers are those who have poor credit history and therefore more likely to default. Lender basically will increase the interest, so it will provide more return for greater risk. Advent of interest on loans basically will lower the monthly payment itself so that the borrowers can afford them, but increase the risk to the lenders because the initial rates will usually reset after 1, 3, or 5 years. But the rising housing market price will comfort the lenders because they assume that they will resell them at higher price. Realized debt obligation (CDO). As housing prices decline, many homeowners who had been using their homes as ATMs found they could no longer support their lifestyle. Default on all kinds of debt actually started to creep up slowly. The real problems of CDOs was that the buyers did not know how to price them. Key factor is subprime mass spread banking industry. Many of the purchasers of CDOs were banks. As the default started to climb up, banks were unable to sell these CDOs and had less money to lend. Those who have the funds did not want to lend to the bank that might default. Uh, by end of the year 2007, the Federal Reserve had to step in as a lender of last resort. Therefore, the banks lent too little, causing the housing market to decline further. Next factor is downturn in real estate price triggered disaster. When housing prices started to decline in year 2006, subprime borrowers could not sell their homes at a higher price than they paid for them. Banks also were not willing to refinance when homes valued less than the mortgage. Instead, bank foreclosed. For the further discussion, I will pass to the Amira as the next presenter. Thank you.
The impacts of subprime mortgage 2008. The first one is low price houses. Second, homeowners move to sub-up. Third, banks are in loss. Fourth, default loans. And last but not least, institutions got bailed out. First one, low price houses. Home prices fell tremendously as the housing bubble completely burst. This crushed many recent homeowners who were seeing interest rates on their mortgage rise rapidly as the value of the home deteriorated. Next, homeowners moved to the suburb. Unable to pay their mortgage on a monthly payment and unable to sell the home without taking a massive loss. Many had no choice. The banks foreclosed on their houses. Homeowners were left in ruins, and many suburbs turned into ghost towns. Even homeowners with good credit who qualified for standard mortgage struggled with the steadily rising interest rate. Third, banks are in loss. By the time these homes were foreclosed upon, they had cratered in value. That meant banks were also taking massive losses on real estate. Investors got hit hard as well, as the value of the mortgage-backed securities they were investing in tumbled. This was made more difficult due to people still buying homes even the bubble began to burst in 2006 into early 2007. Loans were still being given out and taken as sales slump. Fourth, default loans. Investment banks who bought and sold these loans that were being defaulted on started failing. Lenders no longer had the money to continue giving them out. By 2008, the economy was in complete free fall. The last is institution got bailed out. Some institutions got bailed out by the government. Other banks who had gotten so involved in the mortgage business were not so lucky. Effects on financial sector. The Fed support the specific financial institution was not the only expansion of central bank credit in response to the crisis. The Fed also introduced a number of new lending programs that provided liquidity to support a range of financial institutions and markets. This included a credit facility for primary dealers, the brokers dealers that serve as counterparties for the Fed's open market operation, as well as leading programs designed to provide liquidity to money market mutual funds and the commercial paper market. Also introduced in cooperation with the U.S. Department of the Treasury was the Term Asset-Backed Securities Loan Facility (TALF), which was designed to ease credit conditions for households and business by extending credit to U.S. holders of high-quality asset-backed securities. Effects on broader economy. In response to weakening economic conditions, the FOMC lowered its target for the federal funds rate from 4.5% at the end of 2007 to 2% at the beginning of September 2008. As the financial crisis and the economic contraction intensified, in the fall of 2008, the FOMC accelerated its interest rate cuts, taking the rate to its effective low, a target range of 0 to 25 basis points by the end of the year. In November 2008, the Federal Reserve also initiated the first in a series of large-scale asset purchase (LSAP) programs buying mortgage-backed securities and longer-term Treasury securities. These purchases were intended to put downward pressure on long-term interest rates and improve financial conditions more broadly, thereby supporting economic activity. Effects on financial regulations. When the financial market turmoil had subsided, attention naturally turned to reforms to the financial sector and its supervision and regulation, motivated by a desire to avoid similar events in the future. A number of measures have been proposed or put in place to reduce the risk of financial distress. For traditional banks, there are significant increases in the amount of required capital overall, with largest increases for so-called systemically important institutions. Liquidity standard will for the first time formally limit the amount of banks' maturity transformation. Regular stress testing will help both banks and regulators understand the risk and will force banks to use earnings to boost capital instead of paying dividends as conditions deteriorate.
Thank you, Amira. Assalamualaikum. My name is Nadira. Now let's proceed to lesson learned from subprime mortgage. Number 1. Don't rely much on rating agencies. Although credit agencies were hugely criticized for financial crisis and seems to have learned lesson from it, you cannot still rely solely on their ratings. You need to do your own research and your own analysis. Some investors did that and noticed the problem with subprime mortgage in 2008 and were able to avoid risk and even earn profit from it. Second, don't be driven by crowd opinion. And last, you need to diversify within asset classes and individual instruments.